No more FDIC insurance under Trump. Where will you keep your money instead? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So, I was supposed to buy Christmas presents this weekend for Marcus and the kids, but then some of you sent me this Wall Street Journal article. Advisors asked potential nominees whether Trump could abolish the FDIC. So before the headlines spiral out of control, because that's the direction things seem to be headed, as you can see here, Trump prepares to wreck economy with alarming bank regulator plan. As we so often do at Diamond NestEgg, let's talk about what's really happening and why there's no need to panic and pull your money out of your FDIC-insured bank just yet. Here are the 3 topics that we'll be covering in today's video. 1. Why does Trump want to abolish the FDIC as a regulator? 2. Will the deposit insurance at your bank go away as well? And 3. What should you do now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. The FDIC and the deposit insurance it manages is one of the icons of modern America, a visible sign that our savings are safe and that we can sleep well at night knowing that the federal government guarantees our hard-earned cash and that we will not see a return of the bad days of mass bank failures like those seen during the Great Depression. Now, I'm usually not a betting type of girl, but if I were, I would bet that practically all of our members, super savers, and bond course fans would not trust a bank with their money if that bank was not an FDIC member bank, which is our general recommendation on this channel as well. And if you're new to us or need an FDIC refresher, check out our FDIC video here, linked below in the first pinned comment. No wonder then that quite a few of you were shocked and concerned to see headlines like these. Trump aides Mull abolishing FDIC as part of dramatic banking deregulation spree. So, as I mentioned earlier, let's talk about what's really happening. To understand where these abolish the FDIC proposals come from, we need to first understand that the FDIC has 2 primary roles. For savers like us, the FDIC serves as an insurance company. It makes sure that our money is safe. Deposits are insured up to $250,000 per depositor, per FDIC-insured bank, per ownership category. For the banks where we savers keep our money, though, the FDIC serves as a regulator. The regulator who makes sure that its FDIC member banks do not actually run out of liquid cash. And to do this, the FDIC has established a complex set of rules and regulations about things such as minimum reserves and balance sheet strength that the banks need to follow. The FDIC expects regular reports from their member banks about how they're doing and will from time to time visit their member banks for some probing questions and deeper auditing. And yes, the FDIC charges its member banks a fee for these efforts. Now, a bit of tighter bank supervision is not a bad thing, you might think. And you're probably right. But to understand where the calls to abolish the FDIC come from, we need to have a look at how banks in the US are regulated and supervised, and how many different players have their fingers in the pie, so to speak. The regulation of banks in the US is complex business, as you can see from this chart here. It's the best one we could find. And the FDIC is only one box within this financial regulatory structure. So, for starters, a bank can get its license to operate, its charter, as the industry says, either from the federal government or from the state it's based in. The OCC here, the Office of the Comptroller of the Currency, is the primary regulator if a bank has a federal license or charter. The OCC is a quasi-independent bureau of the U.S. Department of the Treasury. If, on the other hand, the bank is a state license or charter, its primary regulator will be someone from the state that issued the charter. For example, the New York Department of Financial Services is the primary regulator for banks chartered in New York, which would fall into this state banking regulators bucket. On the very top here, we have the Fed, the Federal Reserve, which most of our Diamond NestEgg regulars are already familiar with. The Fed not only manages interest rates and the monetary policy of the country, it also supervises many, but not all banks in the country, regardless of whether they're chartered by the federal government or a state. And to make it even worse, there is a multitude of other regulators that will be focused on specific players and segments in the market. For example, the CFPB, the Consumer Financial Protection Bureau, a brainchild of Senator Elizabeth Warren that was created in the wake of the 2008 financial meltdown. Now, unlike the FDIC, most of these regulators here are not household names with the wider population. But even bankers who spend their lives dealing with regulators are often left a bit confused when dealing with this alphabet soup of regulators and managing the various overlaps and contradictions between their supervisors. So the basic idea to maybe combine regulators and simplify this landscape can make sense. And because the federal government can't really do much about the supervision of state banks, they are looking at potentially restructuring and or recombining the regulatory functions of the four key federal supervisors, namely the FDIC, as well as the Fed, the OCC, and the CFPB. From what we could find, one idea out there seems to be to consolidate the functions of some of the regulators into the Department of the Treasury. For example, the functions of the now independent FDIC could be assumed by the Department of the Treasury. Another idea being floated is to create one new super regulator that would combine the supervisory tasks of the FDIC, the OCC, and the Fed. In the words of Elon Musk, there are too many duplicative regulatory agencies. Please do note that the Fed, as far as we can tell, would, under all the scenarios mentioned, keep the responsibility for setting rates and managing the U.S. monetary policy. The hope is, of course, that by combining regulators, we would get more clarity and less interagency competition, as well as a bit of efficiency and cost savings, not an unwelcome byproduct in times of a large budget deficit that needs to come down. That said, nothing seems to be set in stone yet, and we here at Diamond NestEgg will continue to watch the space and keep our community updated on developments. Now, let's move on to the next top-of-mind question for many of us if the new administration were to abolish the FDIC. It's important to keep in mind that abolishing the FDIC does not necessarily mean that deposit insurance itself will be abolished, because under any reform proposal, from what we could gather, deposit insurance would remain in place. It might just be administered by another part of the federal government, for example, the Department of the Treasury itself, or a new super regulator. The reality is that the FDIC would not be the first bank regulator to be abolished. If we look at our recent history, the Office of Thrift Supervision, OTS, was abolished in 2011, and no one noticed. The OTS was a U.S. federal agency under the Department of the Treasury that chartered, supervised, and regulated all federally chartered and state-chartered savings banks and savings and loans associations. It had run into trouble in a previous incarnation when it failed to detect or prevent the savings and loan crisis of the 1980s and 1990s, and was not successful in reinventing itself under a new name. So, the Dodd-Frank Act got rid of the OTS and transferred most of its functions to the OCC, the FDIC, the Fed, and the CFPB. Like I said, no one even noticed. Now, the OTS was abolished under the Democratic administration of Barack Obama, so there might even be some common ground to be found between our two main parties about streamlining regulatory agencies without abolishing supervision or deposit insurance per se. That said, the FDIC, unlike the OTS, has pretty much become a household name, a brand unto itself, you could say. When we hear the term FDIC insured, our general assumption is that the FDIC insured bank is safe and that our money in that bank is safe. FDIC equals safety in this country. No surprise there, given that the FDIC has gained wide recognition and trust with the public for the superb job that it's done in managing bank failures. For example, it usually pays out insured deposits from a failed bank the next business day. And according to Sheila Bair, a former chair of the FDIC has a perfect record of protecting insured deposits for over 90 years. So even if the FDIC as a regulatory organization were to be abolished, renaming FDIC insurance under a new name would be something that I think any administration may want to think twice about. So with that in mind, let's move on now to the next section of today's FDIC video. Now, as I've said before, from what we've seen and heard so far, we understand that no one wants to abolish deposit insurance per se. And even if the FDIC, as the organization managing the deposit insurance, were to be restructured or abolished, I would expect the new administration to maintain the confidence and trust in our banking system by keeping deposit insurance in place. I mean, would we all really sleep well at night if our bank deposits were not insured by the federal government, what's currently known as FDIC insured? I, for one, would keep even less money at my bank than I do already. FDIC insurance is what holds our banking system together, and no administration would want to see a return to the mass bank runs of the Great Depression by getting rid of it. So at this point, I don't think there is much to do. Let's wait and see what happens and try to tune out the alarmist headlines about FDIC insurance going away under Trump. Don't forget, the FDIC is enshrined in law, and the new administration will need approval by Congress to restructure the regulatory landscape for banks. And even though the Republicans will have a majority in both the Senate and the House, Congress has repeatedly shown that it has a seat at the table when it comes to crucial legislation. Plus, the sources for all these circulating news and rumors about the FDIC disappearing are very indirect. It seems it all comes from a few questions that some candidates for senior positions at these regulators were asked in their interviews with the Trump transition team, as per this Wall Street Journal article I shared with you earlier. But let's do a thought experiment, like we sometimes do on this channel. Where would you put the cash that you have in your bank now if there was no FDIC insurance? Drop a comment below and let the community know. And stay tuned on our channel for future updates on how this all develops. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn about bonds as a potential alternative to keeping your cash with a bank and want to really get up to speed quickly on bond investing and building out your bond portfolio while rates are still attractive, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on Thursday, December 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2, 5, and 7-year T-note auctions and all things fixed income. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.